In today's episode of the Brisbane Property Podcast, I'm joined by a new co-host, Stacey May from the Streamline Property Buyers team, and together we're going to be interviewing Sacha Millar, who's the General Manager and co-owner at WBP Group Queensland, who are an independent property valuation firm. We're going to be discussing how you can maximise the valuation on a property that you buy, and also discussing when you might need a valuation outside of a purchase.
Welcome to the Brisbane Property Podcast with your hosts Melinda and Scott Jennison.
Hello, everyone, and welcome back to another episode of the Brisbane Property Podcast. You might be surprised that it's Melinda Jennison here introducing the podcast today. Of course, Scott normally does the introduction. Today, Scott's actually wearing a tool belt at the day of recording. So our business have a new office that is under construction, and we all know about the shortage in the construction industry here in Southeast Queensland. So we've had to get Scott back on the tools for a few days to bring along the project so that it is completed on time. So thank you for your understanding. But we have today welcomed Stacey May, who's going to be co-hosting with me. Stacey from our team, welcome.
Thank you.
And also we have a special guest sharing her intel and knowledge with us today, Sacha Millar from WBP Group, who are an independent property valuation company. Welcome to the podcast, Sacha.
Thank you very much, Melinda and Stacey. I appreciate the invitation to join you.
Well, we're super excited today because we're going to be talking about all things valuations, and this is really important for property buyers, of course. Before we get started, Stacey, we know when we're actually, working with buyers in the real estate space, valuations are really important. Why is it that we're constantly sort of, keeping buyers up to date with the valuation process?
Yeah, look, it's so important for our clients to keep up to date with valuations on properties that they have and make sure that they have a really good understanding of where they're sitting in the market.
So can I ask, Sacha, what is the valuation process? Because as an independent valuer, you know the ins and outs of what's involved. Can you help listeners understand what happens behind the scenes when valuing a property?
Absolutely. Well, 80% of our work is for mortgage security purposes for the banks. So in this case, we receive the order from the bank. The valuer starts his research before he even gets to the property. So, our admin team, they'll call the owner to book in the valuer visit. The valuer is then, doing his research online, doing his sales research. So this is why it's actually really important to provide as much information to the valuer before the valuation. So if you've done any recent renovations, let the valuer know what you've done. Also about providing an estimate to the bank or, when it is under contract, but particularly if it's for sort of getting as much equity out of the property as you can when refinancing. If the bank provides us with an estimate of about 800K, well, the valuer is doing all of his research around that price range. But if he gets to the property and they've done a $500,000 reno and we're now looking the $1.3 million price range, well, it just means the valuer needs to start his research, again, because he's looking in different price range. So that can add a couple of delays. So giving the bank the best estimate you can when it's for those, getting equity and refinancing. So the report's normally submitted to the bank the same day, but what a lot of people don't realise is if the valuation is for mortgage security purposes, it's been ordered by the bank, then the valuer is only permitted to give the information to the instructing party, which is the bank. And I know that can be frustrating for our homeowners because quite often they're paying for the valuation, but they're actually not getting a copy of that report. So that's a little bit of what's happening throughout the process of the valuation. Normally the valuer is only on site. It could be 10 minutes to half an hour. It really depends on the size of the property. Sometimes we'll have people say, well, the valuer is only here for 5 minutes, but it really depends on how much information's online. So for example, if it's a studio apartment in the city, the valuer's already done all of his research. He needs to pop his head in, have a look. Does the property present as he's seen it online? If yes, great, he can be in and out. Of course, when it's a $3-4 million property and it's difficult to measure, he is going to take longer. But in general, it might just be about 20 minutes, for the valuer on site.
Yeah. Perfect. And can I just ask, when you say, you know, the valuer pops in, whether it's 5 minutes, 20 minutes, are there situations where the valuer may not actually enter the property and still provide a valuation report?
Yeah, it depends on what type of valuation the bank is requesting. So obviously these days, moving towards more AVMs, automated valuation models. So the different types of valuations, the banks have got their own algorithm. So depending on the postcode, the type of property, and the risk appetite, the risk profile, the bank's algorithms might decide that this property might a desktop, like an AVM, automated valuation model, or it might be a desktop, which is still done by a certified practicing valuer who operates in that area using his knowledge of that area, but he won't visit the property. It could actually be a curbside where the valuer will drive by, again, won't enter the property, or it could be a full valuation, where the valuer will make the time and the valuer will actually come into the property. You know, there have been times where, you know, I've spoken to people about getting an independent valuation. They've said, oh, don't worry about that. The bank will do one. I just think it's important that people realise that the bank is protecting their interests and their risk. So if the algorithm tells them their automated valuation model is sufficient, that valuation might not get to the contract, or but if it's a low LVR and, you know, it meets the bank's risk appetite, they'll let it go. So even though the customer might think the bank's doing a valuation and we got the tick, the loan's good to go, that doesn't mean actually that valuation, you know, the desktop, you know, or the AVM actually came up to that contract price. Just something to be aware of.
Yeah, that's really interesting. Something you said there, you mentioned 80% of the work that you do is mortgage security work. So that's for the banks. That leaves 20% of your work that I guess is independent of those banks. Why would somebody typically contact you or engage you to perform a valuation outside of mortgage security or you know, for the banks?
Yeah, great. One of the reasons might be we do a lot of work for accountants who are referring work to us for, let's say, capital gains tax. So let's say the client's PPR, principal place of residence, becomes an investment property, then the accountant will want to know the value of that property at that time when it changes purpose to calculate the rise in the value of the property if it's then sold down the track. So obviously no CGT on family home, but there's going to be capital gains tax calculated on the rise in value while it's an investment. We also do them for stamp duty calculations for related party transfers, RPTs, rather than RBT. I got confused when an accountant was telling me about the RBT, but anyway. So, for example, you might choose to sell a property to a child or a sibling, however, at a discounted figure. But don't forget, the State Revenue Office is going to want to take their full cut of the stamp duty. So they are going to request a sworn valuation to know exactly what that property is worth in the open market so that they can calculate the capital gains tax. Might also be self-managed super fund auditing purposes. So there are quite a few self-managed super fund managers who've been contacting us in regards to getting valuations on properties held in the funds. The ATO is cracking down a little bit now on making sure that there are regular valuations to ensure they know the value of that portfolio. So we're seeing more and more, particularly in the commercial space as well, because it's very difficult to do any kind of automated valuation on a commercial property. What else? Wills and estate lawyers. We do quite a bit of work there for example, valuing the portfolio when, you know, they're working through someone's will, dividing assets, etc. Family law, going through divorce proceedings. Visa and migration is another one that comes up here and there as well. At our firm, we also do valuations for insurance purposes. So it might be for the dwelling, or it might actually be for the body corporate to provide the replacement insurance amount for the whole apartment complex. And of course, then before buying, selling, renovating, so we can assist people, you know, to help them make an informed decision when they're buying. There was one example where a client actually came to us. They're looking to purchase this beautiful $2 million Queenslander. They're in their cooling off period. We did the valuation, and our research, we normally do like a development application search in all the neighbouring properties, and actually showed us that the house next door had actually had a DA for a 6-pack of units. So all of a sudden, that beautiful $2 million Queenslander has lost value, because if you're going to have a 6-pack of units overlooking your pool, that's a different matter. So there are lots of different reasons why we might help people with evaluation. Also, to a few when people are renovating, just to make sure that they're not sort of overcapitalising as well. Now, if it's people's dream home and finance is not an issue, well, then if they're overcapitalising, that's absolutely fine. But where it can be an issue is where you do need finance. It's really important to know, where that ceiling is for your suburb. And we do quite a few for helping people when they're doing renovations as well.
Yeah. And how is a property valuation different from a market appraisal that a real estate agent might be providing?
Yeah. Valuations are sometimes disputed on the grounds that a real estate agent has provided an appraisal which is higher than the valuation. So real estate agents are aiming to get the best price they can for their client, the seller, and this is their job. And their appraisal often represents what they hope to achieve for the property if the right buyer comes along at the right time. An agent's appraisal is not a sworn legal document. It does not have the weight of a valuation, completed by a certified practicing valuer. And a valuation report is an official legal document, and it's utilised when we need a definitive value, particularly for family law, wills and estates, visa and migration, etc. So unlike a valuer, the real estate agent's market appraisal, they're not required to defend their appraisal in a court of law. So really it just comes down to that having a CPV, complete evaluation, is that legal document which just has that little bit more weight.
It's interesting that you mentioned the valuation that you did for the buyer under the cooling off period. I'm assuming they didn't have a finance clause, so they were bringing that in under the 5-day cooling off. Is that correct?
Yeah, that's right.
Yeah.
And I do want to comment on that. Most people don't realise that if you cancel a contract in the cooling off period, they still had to pay the termination penalty.
Correct.
That's
yes.
What, 0.25%,
of the contract value.
Yeah. So I think people, they see a cooling off period and they think that that's their out, but there are still termination penalties.
There's a financial penalty. Yeah. And look, we're seeing some buyers do things like drop the finance clause and rely on that cooling off period, even though there is a penalty. If they have the opportunity to secure the property, and if there's a valuation shortfall or something that comes up in the valuation, like you mentioned, then there is a way out. But of course, that's going to cost them. It's not something that we would recommend. And in fact, what I was going to say about that buyer is that they needed a quality buyer's agent before they entered that property, before they entered that contract, because that is the sort of thing that a good quality buyer's agent should always detect and pick up and bring to the attention of a buyer before they fall in love with that beautiful $2 million Queenslander home. No one wants to live in a pack of units. So that's our job as buyer's agents, to detect some of those issues that can affect value, because we do see a lot of people sell off when they find out that they're going to be living next door to units or townhouses, especially once that DA comes through or construction.
Absolutely. No, I agree.
I'll also just say that when you mentioned that a market appraisal from a selling agent is not a sworn legal document, it's interesting. We hear through commentary and conversations that we have with buyers all the time, especially if they're looking to buy or rather move out of a home, buy a big family home and convert that existing home into an investment property. It is so important that they have a valuation report from a licensed valuer as opposed to a market appraisal for tax purposes as well. I'm assuming the ATO don't want to rely on something that a sales agent provides. Is that when, your sworn legal document becomes important as well?
Absolutely. And what I've heard from a couple of accountants recently is that they instruct their clients to get a certified practicing valuer to complete a valuation, because they want that recorded to tick all of the boxes. Because what they're saying is that if you have a market appraisal, there might be a little bit more flexibility there. The ATO might say, you know what, let's dig into that a little bit more and just check that that market appraisal really is in line. What the accountants are saying is they don't want the ATO poking around in any of their clients' business as much as possible. If they get that independent valuation, they can tick the boxes, everybody moves on, no need for any auditing, etc. So yeah, no, that's definitely the feedback we're getting from accountants in that self-managed super fund space as well.
Yeah. And for people wanting a more favourable outcome from their valuation, do you have any tips on what they can do?
I think there's a few things people can do. So, for example, valuers are trained to look through the mess, value the bricks and mortar, but I still think a well-presented home will help, and you want the valuer to appreciate the features of the home. So it's important he can see them. I'd have the lights on and the doors open, everything ready for the valuer. If you can provide the building plans with measurements for the valuer, he is going to have to measure up, but this actually makes it a little bit quicker, means that the report is more accurate, and it means that he's taking into consideration every square metre of that property, and when you're wanting to get the best valuation, that's important as well. We spoke about before providing that rough estimate of value to ensure that he's doing his research in that correct area. That's just about saving time, really, and making sure that there's no delays. If you know of any recent sales in the area, let the valuer know. So, for example, there might be a house that's sold 2 months ago, the for sale signs come down, but it's not yet on the CoreLogic database. The valuer might not be aware of that. So if you know of any of those recent sales, by all means, let him know. Now, the valuer all of his sales in the report have to be settled sales, but if he knows of recent sales, might not yet be settled, but they can still add weight to his thinking as well. List any hard to see features. This is interesting. So sometimes we've had people come back to us and say, you know what, the valuer didn't take into consideration the underground water tanks or the underfloor heating or the solar panels on the back of the shed down the back. Well, if he can't see them, can't take them into consideration. So I know that there was one, this is actually a Melbourne example, but the clients came back and said, well, the valuer didn't take into consideration the hidden wine cellar. Well, if he can't see the hidden wine cellar, probably won't be able to take it into consideration, but that one added like $30,000 to the value of the property. So
wine cellar's worth $30,000. That's an interesting tip for people.
In Melbourne anyway. So I thought that was interesting. And obviously there are, sometimes there's lots of electrical wiring as well with alarm systems and all of these different features. Let the valuer know in advance. Complete the renovations. The valuer doing a valuation on a half-completed property makes it really, really difficult. You're not getting the best value that you possibly could. The other one that's important is don't start the renovations till after the valuation. We had one example. The valuer was booked in at 9 a.m. and this was for a valuation to determine the equity in the home for an owner builder who was doing his own renovations. We get there at 9 a.m. The tradies had got there at 7 a.m., completely gutted the kitchen.
Oh no.
So as you can imagine, we've lost $40,000-$50,000 worth of equity in that property in 2 hours. And that one was really hard too. It was for mortgage security purposes. Now, very, very difficult to do that valuation. So what we decided with the lender is that we'd do the on completion valuation as if the renovations were complete. But because it was an owner builder, he didn't have quotes, he didn't have plans, he didn't have specs. So this took weeks to get all of this information together. So that was, again, an important lesson. If it is an investment property, advise the property manager that you're getting a valuation done. Sometimes the property manager can deny access without written approval from the owner. Again, just delays the process. Providing access to all areas of the property. So if there's granny flats, if there's sheds, the valuer needs to be able to view all parts of the property, can take it all into consideration. Also need to sort of unlock any gates because he needs to walk around into the back of the property. I say he, obviously he or she. Proud of the fact here at WBP Group in Queensland, we're nearly at parity with our male to female valuers, which is actually quite
That's fantastic.
Yes, quite unusual in the industry. Hey, another really important one is pool fencing.
Mm-hmm.
If the property is not in a state that it can be rented, then the valuer is not permitted to put the rental figure into the report. So what happens is when it's for mortgage security, the bank will come back to us saying, well, just wait, we've got no serviceability. You've put 0 in the rental section. What the valuer has actually done has, put into the comments that at the time of valuation, the pool fencing was being repaired, cannot be rented in this condition. However, once the pool fencing is repaired, the rental amount might be $800 per week.
Mm.
But I do remember there was one property where we did have to go back a couple of times because the building wasn't quite finished. The owner guaranteed me the building was 100% finished. It was like a third time going back to get this completely finalised. And what's happened is the tiler got to the property. He was doing some work on the pool tiling. Just as the valuer had arrived, he'd pulled down the gate of the pool fence and pulled down a couple of the panels so he could do all the pool tiling. But obviously we hit the same roadblock again. While the pool fencing was not in a functional state, again, we could not provide that rental figure. What else? Tie up the dog. Now, I used to joke about this actually and say, you don't want the dog, one, biting the valuer, jumping up all over the valuer. And while we used to joke about it, can I just say, since COVID, we've had record numbers of dog attacks on valuers. And what they're saying is it's actually because this new generation of puppies, which were born during COVID, haven't actually been
trained. Left home alone before.
I know. So believe it or not, it's actually, I don't want to say quite regular, nearly once a month we have a valuer being bitten by a dog. So I'm not saying that's going to affect your valuation, but, obviously that could be one less challenge for the valuer that day. That would always help. So not a bad idea to, restrain the pets. And I suppose that final piece of advice is be prepared and prepare as much information for the valuer in advance, because I think everyone knows once you've submitted that valuation to the bank, very, very difficult to get that changed. So any information you have, any recent sales, any of the, hard to see features, make sure you're providing that all to the valuer, at the time of valuation to make sure he's taking all of that, into consideration.
So if we've got a buyer, and I'm assuming this buyer is not represented by a buyer's agent, because it's very obvious what a buyer's agent can do to facilitate that process by providing, their appraisal that hopefully is a lot more detailed than what a sales agent appraisal would provide to their bank or broker to pass on to the valuer, and any additional features relating to the property, as well as any recent sales. And I think from a buyer's agent's perspective, having the ability to access sales that have occurred last week or 2 weeks ago or 3 weeks ago that have not yet settled and therefore are not yet available to the valuer, I mean, that's hugely valuable for anybody that's buying property. But for a buyer that's not represented, what advice can you give to them? Because obviously they're usually represented by a bank or a broker. And I'm assuming a lot of the time the banks and brokers are not saying to their buyer, hey, can you provide me with this or this? What can the buyer do proactively to facilitate that process to ultimately help themselves in ensuring the valuation reaches the purchase price that they've paid?
I think it's really just providing that rough ballpark estimate so the valuer is researching in the right bracket before he even gets there. Just being as prepared as they can with those hard to see features, just having the property in a reasonable condition. But you're right, any sales evidence that they know of, the house that they've been up the road, that they've seen the for sale sign come down, it's those couple of things, let the valuer know, about that one that can sort of really help. They're the main things, really.
So they can take on the role of a buyer's agent.
You know what, it is challenging because sometimes, and we might chat about this later, but when someone wants to dispute a valuation as well, the API, which is the Australian Property Australian Property Institute, and the financial industry, they have come together to set the guidelines for which valuers have to follow when valuing property for mortgage security, but also when there is a dispute. So it is difficult for valuers to change their figures without being provided with new evidence. And so this is where, let's say someone disputes a valuation, the client has to provide the valuer with sales evidence which has not already been considered. That's very difficult for the layperson. So quite often they will go to a real estate agent. But again, if that real estate agent, quite often what will happen, they'll just do a CMA. There'll be 15 sales on there with no commentary. So that's really not going to be of any assistance whatsoever. Where we see challenges being successful is where, an agent or, a buyer's agent particularly, we do see it, where they will provide 3 sales of really fresh sales evidence where they've clearly outlined bed, bath, features, and then made the comparison and demonstrated why that property supports their contract price, etc. So again, challenging evaluation, I have to say it's probably quite rare where that valuation is changed, but there are times when that does happen, and it's when they're provided with fresh evidence that they didn't have access to, where they've been provided with a reasonable explanation as to where this supports the figure.
Certainly makes sense. And I think that, when we talk about challenging valuations, one, that would be a concern. You need to look at what have you originally offered, and in the absence of comparable sales, then someone may overpay, and the bank's really just protecting them from themselves, really, ensuring that they're not going to overpay. But there are some instances, of course, where someone may pay market value. It is what it takes, but unfortunately, there's a lack of that more recent sales evidence within the valuer's report. How does a valuer, account for very recent market growth? I know during COVID, we were seeing growth in Brisbane in some locations of 2.5% to 3.5% per month. And if you quantify that out over, large sums of money, this can be tens of thousands of dollars in a matter of weeks. Is market growth something that valuers do take into account when they're looking at sales that might have occurred 3 months ago?
They do, but it is hard because valuers have to have comparable sales evidence to support their valuation figure. So that's why when we're reaching the next high and the next high and the next high, but no, valuers are taking that into consideration. We have a policy here that if the valuer is not going to reach contract price, they have to discuss that with their managing valuer, who discusses it with the director of the firm, to ensure that if we're going to crash a contract, that we have overturned every rock to ensure that we've done the most research to support our valuation figure rather than the contract price. So it is tricky in a really moving market. Some of the things that agents can do in these situations as well is, again, providing the value of any recent sales which aren't yet on CoreLogic when it's a really hot market. At the same time, valuers are going into 5, 6, 7 properties every day. So they're seeing new contracts being signed every day. So they are keeping on top of that. But the other thing that, we ask the valuers to do is, particularly if it's a record price at an auction and the valuer has got no sales evidence to support that, quite often then they will also go to the agent and say, how many registered bidders were there? How many bidders at the top price? Just trying to beef up our evidence to support that contract price, because you have to remember the reason why banks get a valuation is so that they've got someone to sue when it all goes pear-shaped. So, many of our valuers through the GFC, they saw these prices coming back, and yet a lot of the younger valuers in the last 10 years have just seen this, exponential growth. It is tough for the valuers when it's that, breaking new ground in a suburb, because the valuer has to have the evidence to support their valuation figure. And, quite often you will see commentary in the report that might, say this is at its upper level, and that, they've spoken to agents in the area. They might list the number of registered bidders in their report to provide that evidence as to why they have supported that figure, even if, there isn't the large volumes of sales evidence available to them.
I guess a big one for our clients is that valuation risk at auction, and we always talk our clients through that. But that's some good inside knowledge for them to understand, I guess, the registered bidders and how that auction campaign went.
No, that's right.
Can it happen at auction where you've got a number of registered bidders, and behind the scenes what happens is the highest registered bidder holds the bid and the auction pauses, and through really good negotiation skills on the auctioneer's behalf or the sales agent's behalf, and potentially weak negotiation skills on the buyer's behalf, that buyer shifts $50,000, $100,000 ahead of any other bidder. Is that where you see valuation risk can sometimes come into play at auction? Or again, is that still dependent on comparable sales?
Oh, no, it's dependent on comparable sales. If there's the sales evidence to support that figure, the valuer should be valuing it at that figure. If there's no sales evidence and, that bidder has gone way over and above what the last few bids were, is the value going to dig that deep into it? I can't be sure on that, but the valuer is going to need the comparable sales evidence to be able to support that figure.
So it still comes back to understanding what's recently sold and what value that has transacted, and being sensible about the amount that you're offering.
Absolutely. And it all comes back to, now, valuers are not meant to consider LVR. We shouldn't know the LVR. We value the property as we see it in the open market at fair market value. But what we find is that, if financing is an issue, people can bid whatever they like. It's where you need that finance. You need to be, a lot more careful.
Yeah, that makes sense.
We do pre-purchase valuations for people before they go to auction to let them know what that, property should go with. At the same time, there have been situations where we've done that valuation on the comparable sales evidence and what's available at the time. It's not to say that bidding isn't going to go a bit over that in this market. But at least around where the bank is going to value that at, just to make sure you've got all your ducks lined up.
I'm conscious of time, but I'm really curious about the next question I'm going to ask you, Sacha, because sometimes in our market, especially in the property investment space, we see people, purchase property, and then within a few months they say, hey, bank valuations come in X amount over purchase price. We've locked in this much equity. Can you help listeners understand how long is a realistic time frame between when the property transaction itself sets the new market benchmark for value? How long is it before a new valuation is likely to show any uplift in equity? Is there generally a time principle that applies, or is that variable depending on other factors?
I think it's really variable depending on the market, how the market's moving. I mean, by rights, a valuation is valid for 90 days. So anything over that 90 days, there could be movement, in the market. I mean, normally we're not doing them for clients more than every 12 months. But we know in the current market, it's really been unusual what we're seeing in the apartment market in Brisbane at the moment as well. But usually that 90-day mark is the, validity period for a sworn valuation.
Good tips. Thank you, Sacha. If people want to get in touch, I know a lot of our listeners are obviously property owners here in Brisbane, or property investors looking to buy in Brisbane, or home buyers looking to purchase in Brisbane. They might be looking to upgrade, and therefore they might be looking to hold their existing home as an investment property. They might need a valuation. If people need a valuation independent of what the bank might order for them, how would they get in touch with yourself and your company?
Absolutely. You can either go to the website, which is wbpgroup.com.au, and go to the Queensland page. That will take you directly to our team, but also very welcome to connect with me on LinkedIn. I know when I've said that in the past, people found it tricky to find me because the spelling of my name, so it's like Sacha and Millar. But by all means, go to the website, connect with me on LinkedIn. Really happy to chat and help however I can.
We will make sure that your name is spelt correctly in our show notes, and we will include a couple of links so people know how to get in touch, and it will make that process easier for our listeners. Sacha, thank you so much for your time today. We really appreciate all of the knowledge that you've shared with our audience, and we appreciate you coming on the podcast.
You are very welcome. Thank you so much.
Thank you. Stacey, thanks for joining me and stepping in as co-host today. It's actually not been too bad.
No, it's been great, and I can't wait to see what Scott's getting done at the office.
We're all looking forward to seeing that. And thank you once again to everyone that's tuned in to today's episode of the Brisbane Property Podcast. As always, we hope you have enjoyed this episode. Please don't forget to leave us a review. Share this episode with friends and family, especially those that may be needing that independent valuation on their property anytime in the near future. We hope you have a fabulous week, and until next time, bye for now.